Hello, welcome at UBP TV. I'm Denis Giraud. I'm responsible for the Emerging Market Fixed Income Group at UBP. Today, with Kun Shao, we will share with you our views on the emerging market fixed income for the rest of the year. So far, this year, emerging market has been one of the best performing assets. The emerging market sovereign debt in dollars has yielded about 3.5%. And the emerging market corporate debt in dollars has returned about 4.5%. And those despite bad news on the economic side and also depressing commodity prices. Now, having said that, let's talk with Kun to share with you our views on the market. Hello, Kun. Welcome on UBP TV. Kun, can you tell me if the global economic forecast supports modest positive outlook for EM markets or not?
I think it does. We've already got some decent stories in emerging markets. We've got some good reform stories. The reform champions are India, Mexico and Indonesia. What they've been doing is to provide measures to support businesses. They've also been trying to strengthen their own balance sheets, trying to strengthen the country balance sheets, and all of these things have already started to support growth. Indian growth this year is likely to be 7.5%, which is faster than China, and I think going forward it could be even higher. Also within emerging markets, you have regions which are doing very well. Despite some of the negative news, you've had regions such as Middle East doing very well because the governments are spending more to support infrastructure. Closer to home, you have Eastern Europe doing better because they're able to sell more to the euro area, which is not doing as bad as it was in the past. The negative stories, the negative developments in emerging markets has been out of Brazil and Russia, but arguably this is the low point. If we have commodity prices stabilize or go up a little bit, if you get the political friction between Russia and Ukraine lessen, I think those economies, Russia and Brazil, can be looking better into next year. So I think, the economic outlook does support a constructive outlook for EM markets.
The US will have some stage to increase interest rate, and the US dollars has been rising in anticipation of this. Do you think it will hurt the emerging market economy?
I think when the Fed does eventually hike, it will cause more volatility, but it's going to be volatility across global markets. I don't think the Fed actually needs to hike much once they do start to move. Let's not forget, inflation in the US is very low. It's likely to remain low with the dollar generally rising. Also, remember that debt levels amongst the household in the US is high, so you don't actually need to tighten much to slow things down. An important factor for global interest rates is what other central banks are doing. The ECB and the BOJ are engaging in pretty powerful quantitative easing. If you sum up the amount of asset purchases by these two central banks, you get annual asset purchases which are equivalent to 1.8% of global GDP. That's huge. Finally, global savings rates have been going up. They've been going up because of the caution that households have, but also because of powerful demographic factors. This is creating a lot of capital to go out into global markets to keep yields depressed. So I think when the Fed does eventually hike, it's going to be a source of more volatility, but I don't think it's going to be a big problem for emerging markets.
Finally, what about China? The economy has slowed down, and as a result, commodity prices have come down. But at the same time, the equity market has been rising significantly. What are your thoughts about the economic outlook for China and also the implication for the rest of the region?
You're absolutely right. The economy slowed down, and the recent data has been disappointing. It's been soft. However, what's very important is that policymakers have already started to act. In the last 2-3 months, we've seen monetary and fiscal policy being loosened. Recently, we had a very significant cut in the reserve requirements faced by banks. This is going to provide a lot of liquidity into the banking system. That, together with fiscal easing, is going to provide a boost for growth. Also, behind the scenes, you've seen Chinese policymakers do more to support the housing market. So this is also going to provide a boost for growth. I think it's also important to remember that Chinese policymakers have a lot of options, and I think if necessary, they're going to stimulate domestic consumption more. And I think households will respond to measures to stimulate domestic consumption because households are in a good shape. The unemployment rate is low, wage growth is high, household debt levels are low. So if the government gives them more, I think they'll spend it. The government on its side is able to do more as well. I mean, central government debt levels are low, the credit rating is high, the ability to borrow and spend is solid. So I think by the middle of the year, we're going to see Chinese growth do better. And when it does better, I think people are going to be a bit more relaxed about Chinese markets. But importantly, they're going to be a bit more relaxed about Asian growth, trading partners of China. And also, you're going to get commodity prices enjoy a little bit of a lift because China is such an important consumer in global commodities. And if that happens, then you're going to get major commodity producers in Latin America, in Africa, benefit from a feel-good factor. So I think right now, this is the low point in terms of Chinese economic growth. And when it does pick up, it's going to have positive spillover for the rest of emerging markets. I think people need to remember that emerging markets is a very diverse place. And even now, despite the slowdown, you have pockets of very good news. You have places where you have the champions of reform who have been doing a lot and they're being rewarded with stronger growth. You have other regions which are picking up as well. But importantly, you have Chinese growth at the low now. So when that picks up, you're going to get people more comfortable about the overall emerging market outlook. And I think that's going to spill over to emerging markets. I think it's important to take into account that with these positive factors, you're going to get a supportive lift for probably the best quality assets within emerging markets, which we think is the medium to high grade quality instruments in the fixed income space.